everybody in the business is a chart guy. So Taylor, can you draw a little horizontal line right over here? Okay, good. That peak right there, take it straight across. Right there, good. Terrific. This is a beautiful chart. So that's why I consider myself a trender, not a trader.
I'm Steph. I'm head of investment strategy here and joined by...
I'm Taylor Mann. I'm a product manager at Robinhood by day, and by night I am myself retail trader who's been using technical analysis for about a decade. Thank you. Before we get started, I do want to remind everyone this entire session is for educational purposes only. John, who's going to join us on stage in a moment, works for 22V Research. They are not affiliated with Robinhood, and all opinions are his own.
Okay, we're going to do three things today. First, we're going to hear from our legend, John Roque, give us lessons that he's learned over his 30-plus year career. Then we're going to chart some live and pre-planned examples, and then we'll take questions from the audience.
As noted, you're going to get to hear from a legend of technical analysis here in a moment. Before we do that, I want to level set quickly on the basics of technical analysis. If you distill it to its most distilled form, technical analysis is just the study of price. We use historical price data to attempt to predict and inform our trading based on future price movements. You can add in time and volume as well to assist in making trading decisions.
So I would like to welcome John Roque to the stage. He is the Senior Managing Director and Head of Technical Strategy at 22V. He started his career in 1997 on Wall Street and worked for firms like Lehman Brothers and Soros Fund. And he's also a ranked technical analyst on Institutional Investor. John, welcome.
Hi, Steph.
Hi.
Hi.
You know what? I have learned so much from you just prepping from this, and of course over the years that I've been watching your research.
Thanks.
So I'm gonna leave the stage and let you take it away and focus on, share the lessons that you've learned, and then we'll come back on and do some charting.
Okay. Thanks. Thank you. Okay, everybody, I'm John Roque. Pleasure to be with you. I was born and raised in Mount Vernon, New York, and I did my university in the Bronx. So if there's something you don't understand because I'm told I have an accent, please raise your hand. Okay, here we go. I believe that when we are market participants, we must put the odds in our favor. I believe firmly that you should never listen to anybody who says, I feel like this is going to happen. I felt like I was going to play for the Yankees. That didn't work out. So you should not do anything about feeling in this business. You should be able to prove it. You should have some historical grounding to your work. You want to put the odds in your favor. I know Obi said earlier on in his session that he didn't want to necessarily use a gambling kind of analogy, but that's what we're trying to do. We're trying to put the odds in our favor, and I'm going to show you how I put the odds in my favor and how you might want to use the same tools to put the odds in your favor. Okay, has anybody ever seen either in stage form or on the screen in movie form the play and movie Guys and Dolls? Has anybody ever seen that? Terrific. One. Me too. I promise if you rent it and you don't like it, I will refund you the price of your rental for that. Frank Sinatra's in it, Marlon Brando is in it, and Brando sings. It's a wonderful movie. It comes together by the writings of a former columnist by the name of Damon Runyon. He did a series of articles based on the Prohibition-era Broadway scene. Lots of characters. Although Runyon didn't say it, he believed that the race is not always to the swift nor the battle to the strong, but that's the way to bet. And that's how we should think about with respect to our market decisions. Okay, Steph said that I had the very good fortune to work at Soros Fund Management. I was there for 4 years. I thought it was like being asked to play basketball for the University of North Carolina when Dean Smith was the coach. You had to go. It didn't matter if you were in the starting lineup or not. Just to sit on the bench for Dean Smith or to be a part of Soros Fund Management was a way to just learn via osmosis, keeping your notebook open, keeping your ears and eyes open, and most of the time, keeping your mouth shut. I have some very funny George Soros stories. None of them are pejorative, but I've done a pretty good job trying to learn what he was willing to teach. So I'm going to ask you this question. What do George Soros, George Tenet, and Stanley Druckenmiller have in common? So I'll just preview them. George Soros is perhaps the most famous, or one of the most famous hedge fund investors of all time. George Tenet is a Queens kid, Queens, New York, who then ran the CIA. And Stanley Druckenmiller is perhaps the greatest investor of all time, who ran the quantum fund for George Soros. What do all three of these guys have in common? They all believe the same thing. Here's a story I learned at Soros Fund Management. George Soros was famous for saying, "Just give me enough information." How many of us out there, when we're making an investment decision, try to cover all the bases, try to have every piece of information at our disposal to make a decision? I think it's kind of a waste of time. We can't learn every piece of information. In fact, most of the information already known by all existing investors shows up in the price chart. That's what the chart is telling you. It's giving you an idea as to who has the upper hand. Does the buyer have the upper hand, or does the seller have the upper hand? So George Soros said, "Just give me enough information." There it is right there. Now, I was once in a meeting with George Tenet when I was at a second shop on the buy side called Key Square Asset Management. And all the guys in the meeting, my coworkers, tried to ask George Tenet very complicated questions. What was Saudi Arabia going to do with oil? What about the North Korean threat to South Korea, etc.? And when the question came around to me, I should have asked him the following question, which I didn't. I should have said, "Mr. Tenet, did you learn all you needed to know about running the CIA when you worked at your family's diner in Queens, New York?" But that's not the question I asked him. I asked him the following question. I said, if it was going to take you about 5 years to get 100% of the information for you to make your decision, or is going to take you 2 years to get 70% of the information to make your decision, when would you make your decision? He said, that's a really good question. He said, I'd make it after 2 years with 70% of the information instead of waiting for the 5 years. And then lastly, Stan Druckenmiller, who is, and I'll say this again, I want to be clear, he is likely the best investor of all time because he did it in all asset classes: commodities, currencies, equities, bonds, etc. All of them. He said famously, and just to give you an idea, I have a file in my Word on my computer, and I call it Investing Aphorisms. And I've collected all these quotes for the entirety of my career because, to me, it's medicine. It is philosophy. It is giving you the insight from great investors. He said famously, you don't get paid extra for complexity. We want to keep it as simple as possible. George Tenet corroborated this, and George Soros corroborated it. Okay, I think this is going to corroborate what was already corroborated. So in the early to mid-'70s, there was a guy named Paul Slovic. He conducted a horse handicapper study. In fact, my question to George Tenet referenced this topic itself because this topic was on the CIA's website at that time. So Slovic, and I'll show you the graphic just after this, gathered some, let's say, bettors, for lack of a better phrase. Sorry, Obi. And he conducted a study. He wanted to see what was going to allow them to do better when they struck their wages. Okay, here goes. So Paul Slovic found this out. If it was good enough for Slovic, if it was good enough for Soros, if it's good enough for Tenet, it's good enough for Druckenmiller, heck, it's good enough for me. With 0 data points, the horse handicappers had a 10% accuracy rate, and their confidence rate was also 10%. Then Slovic increased their data points, went from 0 to 5. The accuracy went up 70%, went from 10 to 17%. Their confidence went up 90%, from 10 to 19%. Then Slovic went overboard. He gave them a ton of information, 40 data points. The accuracy did not go up, but man, were they confident. So the Soros, Tenet, and Druckenmiller lines, along with Slovic, kind of paint a picture for me or create a narrative. So Steph said, and she said it kindly, thank you very much, I've been in the business for a long time. There are more unanswered questions than there are answered questions. And because I am a technical guy, I've become, let's say, familiar with chart patterns. I know which one I want to be associated with, and I know which ones I don't want to be associated with. I get phone calls and emails and IMs from investors that are our clients at 22V all day long. And they'll say, what do you want to do with this stock? And if I'm interested or I think I can do something with my own money, I'll give them an answer. But if it's not my style, I'll just say, it's just not my style. I don't know what to do with this. I never have any success with this setup. I don't want to make it too complicated for myself. And I think people in the business sometimes tend to make it too complicated for them to win. You don't have to prove how smart you are. You really just have to win. Okay, so here we go. Less is more. We saw that from the Slovak horse handicapper study. Data points above 5 only serve to increase confidence. It didn't increase your rate of return, though. And then lastly, with more information, we just kind of reinforce a bias that we already have. And I actually think with more information, you become way overconfident, which is what that graphic showed us. Way overconfident. And I think in this business, you have to have a low level of hubris. Pragmatists prosper in our business. Dogma is death. You want to be pragmatic in our business because you could be right today and exactly wrong tomorrow. Oh, one more. Here we go. Just to reaffirm, beyond the most relevant data, and I'm going to show you what's relevant to me, and I think it will be relevant to you. And I'm hoping when I'm finished with this, there'll be some questions, but I'm also hoping that you'll take away that less is actually more. It's easier to keep track of when you're doing less is more. Again, we just use additional information mainly to confirm existing biases. Keep it simple. Okay, I played baseball in high school. I played baseball in college for a few years. I've coached my sons. I actually umpire girls' tournament softball outside of charts, and my mother, baseball's my love. There was a guy named Mariano Rivera who pitched for the Yankees. He crafted a Hall of Fame career. He threw really just one pitch. It was called a cut fastball. In fact, when he retired, I think it was maybe the Minnesota Twins, gave him a rocking chair made up of all the bats that he broke over the years with his cut fastball, which used to bore in on the hands of lefty batters. He said, nobody taught me the cutter but God. Now, the story goes when he was early in his career and Joe Torre became the manager of the Yankees, all of a sudden, from one spring training to the next, Mariano Rivera kind of picked up 15 miles an hour on his fastball or on his cut fastball. They didn't know where it had come from. So I've met Mariano Rivera. He has big hands, very long fingers. My older son played baseball with his older son, and my younger son played soccer with his younger son at the same high school. The point of this is that Mariano Rivera didn't have to throw a knuckleball. He didn't have to throw a curveball. He didn't have to throw a changeup. He didn't have to throw a sinker. He didn't have to throw a slider. He threw one pitch and crafted a Hall of Fame career. Some will tell you, based on a stat called WHIP, walks plus hits to innings pitched. It's a ratio. Based on the WHIP stat, he is the greatest pitcher of all time. The greatest of all time. In fact, before the Yankees kind of reached their peak in the early 2000s, I thought sometimes when he came into the game, the other team just sort of gave up because they played Enter Sandman as he came in from the bullpen, and the other team knew it was over. But nobody ever said to Mariano Rivera, you've got to learn a different pitch. He did one thing and did it exceptionally well. I'm just going to get to the end of this point right now. How many of you on your screens at home have technical indicators on your screens? Yeah, everybody. How many have more than one technical indicator on their screens? How many people have more than 2 technical indicators on their screens? How many people have more than 3? What are the technical indicators showing? Anybody can yell it out. What are they reflecting? They're reflecting the action in price. RSI reflects what's happening in price. MACD reflects what's happening in price. Stochastics reflects what's happening in price. They do it at different speeds, but they're all reflecting the same thing. Why do we have so many of them? Why don't we just get really good at one of them? So I hope I'm not stepping on Steph's toes here, but when I got in the business, there was a guy who worked for Dean Witter. His name was Phil Roth. He was, a technical analyst of some renown, and I went to then the Market Technicians Association, MTA, which is now called the CMT, to hear Phil Roth speak. And when you went in, there were some brochures on the table, and I sat down to hear it. And Phil Roth had a nickname. He was known as the Indicator Man. And then within the brochure, it said that he kept hundreds of indicators. And I said to myself, because I was a young guy in the business, man, I got to listen to this. I've got to learn about all of these indicators. I'm going to see if I can duplicate them, because I didn't have, the software wasn't available. I used to have to make the indicator formulas in Excel. And so I listened to Phil Roth, and I went back to work, and then I was doing it at home, and the computing power was terrible. I'll tell you how bad it was. When I was at Lehman Brothers in the mid-90s, no offense intended to the Robinhood software, there was one Bloomberg machine on the entire floor. One Bloomberg machine. Lehman Brothers was a big firm at the time. I would get in at 6 a.m., walk around the floor, print out all of my data, go back to my office, and put it in by hand. That's the way it used to work. In fact, I'm so old that when I got in the business and learned technical analysis, I used to do it by hand with a pencil and a ruler and graph paper. That's not a joke. And I knew when a stock was bullish when I had to add a piece of graph paper to the top of the graph paper because it broke out. And I knew a stock is bearish when it broke the bottom of the graph paper and I had to use a glue stick to add something to the bottom. So I've really been doing this a long time. And I learned from Phil Roth, although he didn't try to teach me, that I didn't need all those indicators. I really just needed one or two. Rob Bass and DJ Easy Rock said it takes two to make a thing go right. You really only need two of them. And I'm going to get into that with you. Okay. So I'm going to reveal to you, I'm going to open the kimono. I'm going to tell you what my raison d'etre is. What do all of these charting patterns have in common? So everybody sees these all the time, right? We're trying to call them out. Doesn't this look like an ascending triangle? Doesn't this look like a triple bottom? Oh, what about this? Don't you want to sell this double top? So I don't do those things. I really don't. I try to find bases. Does anybody know what a base is with respect to chart patterns? Bases are really kind of sideways trading ranges. Now, you need a base for just about anything you do in life. You're going to build a new house, nobody builds it on a stilt. Create a great foundation. Anybody's going to get in the batter's box to try to hit Mariano Rivera, they're going to be steady and firm in the batter's box, right? Anybody's going to shoot free throws for the Miami Heat, they don't shoot free throws on one leg. They set their feet, good base, they shoot free throws. Does anybody do any Olympic-style weightlifting? If you're going to do deadlifting, you better have a good base or else your back is finished. What about, does anybody do any martial arts, any sort of judo or jiu-jitsu? If you have a bad base for that, you are submitted. I do that stuff on a Saturday. My sister calls me right after the class and she says, how was Get Beat Up class? I was once on CNBC and I went back to my desk and there was a phone message on my phone and my sister's a real wise guy. So I hit the number, I picked it up and she says, John, I just have two words for you, chap stick. And then she hung up the phone on me. Anyway, all of these patterns, they have these great names: ascending triangle, cup and handle, which was divined or figured out by Bill O'Neill, double bottom, triple bottom, rounding bottom, inverse head and shoulders. I'm really just trying to find bases. And there's a base in all of these. There's a base in the ascending triangle when you get above the resistance. There's a base in the inverse head and shoulders when you get above the horizontal line. There's a base here when you get above the rounding bottom. The triple bottom's not important to me here. Getting above that horizontal line breaks out of the base. That's important to me. The double bottom, okay, but when you get above that prior high in the middle of that W, that's important to me. And then, yes, of course, this is a cup and a handle, but there was a base inside the cup and then a base when you break above the handle. You want to find bases, and I'll tell you why. Because your odds of success get better when you find bases and when you buy bases and breakouts. Do they all win? No, they don't. No, they don't. But if you use stops wisely, the base and breakout model is very profitable. Now, I'm going to add in another thing, because I said you need two to make a thing go right. If you find any of these patterns, which I'll just call bases because there are bases within all of them, and they are joined by upward sloping 200-day moving averages, that's like having a bodyguard at your back. I will say unequivocally that if any people in here adopt a base and breakout method while also considering whether that item is above an upward sloping 200-day moving average, I will nearly say with great certainty your odds of success will go up. Pardon me? 200-day moving average. I like to look at monthly charts and I like to look at weekly charts. So thank you. That's an excellent question. I should say this right now. I'm not a trader. I'm a trender. And I'll tell you why I'm not a trader. Because I'm not better than any machine, and I'm not better than any guy or girl that sits at their desk for 10 hours a day trading. I'm not better than any of those. But I think I'm pretty darn good at trend. So that's why I consider myself a trender, not a trader. I sleep a little better that way too. Okay, so I actually previewed my answer. This is it, bases. Okay, so does anybody remember reading, perhaps in their high school years or in their younger years, Gulliver's Travels? Anybody? Okay, does anybody remember that Lemuel Gulliver, traveled to the land of the Lilliputians? They were small folks, right? Does anybody remember where else he traveled? It was the land of the giants. It was the land of the Brobdingnags. So I just created this word by making it an adjective, Brobdingnagian base, which just means giant, huge. And the phrase Brobdingnagian base has come to be associated with me so much that people will call me and say, do you have any of those how do you say that word? Number two is my older son is a lawyer. He helped me trademark the phrase. So Brobdingnagian base is my phrase, but you're free to use it. And if you find one, send me an email. Maybe I missed it. So this is the framework for big advances. I'm going to show you some Brobdingnagian bases because Taylor and Steph kept them in my chart presentation, but we'll go over them. And maybe we'll go over a few on the live charting, which will give you an idea what it looks like real time. Okay, here we go. So Jonathan Swift wrote the book, and so we're using a redwood tree here just to give you an idea what the Brobdingnagian adjective means. I think it's really funny that even I can't say it. Okay, and as Captain Ahab was to Moby Dick, I'm always on the hunt for the Brobdingnagian base. So I worked with a guy, this is a tangent, but I'll tell you anyway, who went to interview at Merrill Lynch when there was a giant Merrill Lynch trading floor down at the World Financial Center, which was east of the World Trade Center. And they may have had 300 traders in the room. And my friend, who became my colleague for many years, was a UPenn English graduate, but he loved the business, wanted to get into business. So he had some meetings with some traders, and he fancied himself kind of a man of letters because he was an English major. And he sits down with this senior trader. The trader says to him, I'm looking at your resume. I see you're an English major. He said proudly, I am. The guy said to him, what's the first line from Moby Dick? And my friend didn't know, and the interview was over. The first line is call me Ishmael, because Ishmael narrates the story. Anyway, here's another example of base. This is a deadlifter. Of course, he's got some straps there to help himself. But the base sets you up for important gains, really important gains. I think it was, I can't remember who said it now. Anyway, it's one of the aphorisms that I've kept, but I can't remember who said it. Does anybody know traders, other people in the business, or retail traders who tell you that they sold the top and bought the low? Nobody does that except for liars. It's not easy to do. Not easy to do. In fact, I'd rather see the bottom form and then try to get into a trade. I'd rather see the top form and then sell a stock or short a stock. I don't need to be the first guy out or the first guy in. I don't need to be. Okay, so I've been looking at charts, as Steph said, since the mid-90s. That's a long time. When my sons were younger and I would get charts, this is not a joke, delivered to my house on a Saturday morning in a cellophane package. It came from Mansfield in Jersey City, New Jersey, and a guy would deliver them to my doorstep on Saturday morning. My sons were very young. I'd get the chart packet from the front stoop, go into the table, and I'd say to my son John, here's a green crayon. And I'd say to my son Sam, here's a red crayon. And I'd flip the chart and I'd say, circle that green, and I'd say, circle that red. And that's how I just kind of practiced to see all the charts I could possibly see. And then I made lists. And then you'd have lists of good charts and lists of bad charts and lists of I don't know what else. There was a famous strategist in our business. His name was Byron Wien. Does anybody know the name Byron Wien? Terrific. Byron Wien was a true gentleman. He worked at Morgan Stanley for years. He was there at the same time as another legend in the business by the name of Barton Biggs. But after leaving Morgan Stanley, Byron Wien worked for a firm called Pequot Capital Management. And I went to visit him one day. And he knew I was a technical guy, and I had never met him before. And it was like, Moses going to the mountaintop. I thought I was going to get some real, juicy tidbits from him. So he said, John, what do you like here? And I said, hold on, Byron, let me pull out my list from my bag. And I pulled it out. He said, hold on, I'm going to pull my lists out too. The lesson to me was even a great strategist like Barton Biggs was a chart guy. Everybody in the business is a chart guy. Does anybody know the book called More Money Than God? Terrific, right, Obi? Terrific. Read More Money Than God. You'll see that all of the great hedge fund managers of all time are chart people at one point or another. Read More Money Than God. It's really a good book. So bases are clear to me. They are clear. I can see them. Also, when a stock breaks out, let's not kid ourselves. It's not breaking out for my reasons. It's breaking out for fundamental reasons. The base suggests that a fundamental story is coming together. Whatever reason, there's a new CEO, there's a new product, they're paying down some debt, consolidation in the industry, new product. We can all craft millions of reasons why a stock goes up. Immaterial to me. I just want to identify the base because I know that there's likely a good reason for that base forming. The breakout is the manifestation of a fundamental story. Now, I'll tell you, breakouts don't always work. But when they don't work, it should give you a clue about the market. I'm going to tell you the best indicator of all time for your own portfolio. This is it. Are your longs working better than your shorts? That's how you know what sort of market you're in. If your shorts are working better than your longs, there's only two possible answers. Either you're really good on the short side or the market's going down. Because the market's always biased up. Always biased up. Goes up out of every 4 years. If you go back to the late 20s and you put any date in history, October 27th, 1942, and you take 1 year out, 1943, the market is up 2/3 of the time. Any date in history. The only reason the market goes down is because there's a recession or a bear market, and they're usually the same. So if your shorts are working better than your longs, either you're really good on the short side or the market's coming in. There's no other reason because the market is biased up. Base and breakouts, again, are the manifestation of a fundamental story. And again, bases and breakouts put the odds in my favor. Okay, thank you to Taylor, Steph, and Obi for allowing me to put in a few baseball references. Thanks. So, again, I said earlier, I worked at Soros Fund Management, and I worked for Robert Soros, who is George Soros' son. And I would ask Robert Soros a million questions about his father. I didn't want to learn anything personal. I wanted him to give me the insight that I was craving about the market. And I said to him one day, I said, Robert, did your father have a better batting average or a better slugging percentage? And he said to me, oh, John, his batting average was terrible, but his slugging percentage was fantastic. When he was right, he really bet big. Stan Druckenmiller has a cute line off of that. Stan Druckenmiller says, "It takes courage to be a pig." Meaning, if you're right, you really have to make that bet bigger, right? That's sizing that's important to your portfolio. And I would bet in your own portfolio, if you remove the stocks that are not working well for you, your rates of return are going to get better. You should not say or justify why you're holding the stock that doesn't act well. That really doesn't help you at all. If it doesn't act well, see you later. Trading costs are almost nil, if not nil. You could come back in if the stock changes its behavior. Don't justify losers in your portfolios. You don't want to justify losers in your life, right? Why do you do it in your portfolio? People on Wall Street sometimes water their weeds and cut their flowers. That's not the way to run a portfolio. You want to water your flowers and cut your weeds.
Let's get down 90%.
Ah, nice. That's another lesson. That's next year's seminar. Yeah, that's next year's seminar. Okay, here we go. So these are legitimate numbers. So these are baseball counts. If you're at the plate and the count is 0-0, your on-base plus slugging percentage is almost what they call 1,000, right? 1-0, 2-0, 3-0, 3-1, 1-1, and 2-1. 2-1. Those are good hitters' counts. I used to say to the kids on my teams, I'm not going to teach you how to hit. I'm going to teach you when to hit. When you're in those counts, you want to take a big swing. You don't want to hit a crappy ground ball to the second baseman. You want to hit a ball into the gap. You want to have a double or a triple. When the counts are in your favor, you want to take a big swing. That's what bases do for me. They put the count in my favor. Sometimes, am I going to take a big swing and line out to the shortstop? Yeah, of course. Sometimes, am I going to take a big swing and whiff? Of course. But the counts are in my favor. I know ultimately I'm going to succeed because the odds are behind me. There we go. Sorry, I keep previewing my own statement. Bases put me in a hitter's count. Okay, and this is the DJ Easy Rock and Rob base. It takes 2 or 3 things to make a thing go right. Okay, I mentioned the 200-day moving average earlier. I will guarantee that most of the money you make in your trading careers is made with items that are above upward sloping 200-day moving averages. And I will nearly guarantee the most money you lose on a long trade is for an item below a downward sloping 200-day moving average. I'm going to make an example. Obi might say to me, John, what do you think about stock XYZ? I say, you know, Obi, I can't buy it here. It's below a downward sloping 200-day moving average. He says to me, well, John, you know, it's really cheap on fundamentals. And I'd say, can it get cheaper? Right? Let's talk when it stops going down. So you want to have stocks that are above upward sloping 200-day moving averages. The slope is much more important than the crossover. How many guys see or hear from other people that they know who trade or invest, and you say, oh, this stock just crossed above its 50-day moving average. Anybody ever notice that sort of stuff and it's supposed to be bullish? It's not really bullish. Is the stock crossing above an upward sloping 50-day moving average? That's much more important. And lastly, I use rate of change. So if we had the Taylor, Steph, John, Obi, and my colleague Ryan is here. If we had these 5 people investment company, and Steph was the PM, and Taylor ran the business, and Obi was the trader, and Ryan was going out to raise money, and my job was to find ideas to buy, because we're a long-only shop. I would look at all my stuff over the weekend. On Monday morning, we'd have our meeting. I'd push my charts to the middle of the table. I'd say, here's the 10 stocks we would buy. And everybody would say, well, why are we buying those? And I'd say, well, all 10 of them are above their upward sloping 200-day moving average, or because I looked at a 12-month moving average, and their 12-month rate of change has moved from negative to positive. I don't need much else. What's the MACD saying? Okay, could it be overbought? All right, fine. Let's buy it on a pullback. Is the RSI overbought? Yeah, okay, fine. Let's buy it on a pullback. But if a stock moves above an upward sloping 12-month moving average or a 200-day moving average, and the 12-month rate of change gets to positive territory, that's worth it. You don't need much else. Oh, and here we are.
John, let's jump into a couple examples.
Yeah, let's jump in. Okay. Thanks, Taylor. Thanks, Steph. So I met a guy in the elevator yesterday with Ryan who was here. He was a PhD. I don't remember his first name, but he worked for Kathy Wood at ARC.
Oh, yeah.
I don't remember his name. My apologies, sir. So I'm going to give you a little background story. Here goes. In 2009, I was at a firm that no longer exists, and I went to see Kathy Wood when she worked for Alliance Bernstein. And she said, John, what do you have for me? I said, Kathy, I really want to buy Amazon. She said, why do you want to buy Amazon? I said, because it has this big base that goes back to 2000, the year 2000. It's a 10-year Brobdingnagian base, and I think it's going to break out. She said, I really like it long, too. I said, well, why do you like it? And she was on it for fundamental reasons. So the credit goes to Kathy Wood. That's not the point. The point is that I was identifying something technically that she was quite confident about fundamentally. Look at that. So you remember the 1999-2000 period when there was a big tech peak? Amazon went down about 90%. Amazon went down about 90%. It rebuilt over 10 years. Now, I'm sure there are some guys in here who are cynical. I'm cynical the older I get as well. And people would say, oh, John, where the heck were you at 50 cents? You're right, I missed it. I missed it, okay. But I want to buy that breakout. So it made me feel a lot better by buying that breakout because I missed it at 50 cents. And it's still paying me the entire time.
So in this chart, I just want to ask,
Of course.
you wait till it gets to that resistance level where the base breaks out?
So there are two ways really to play it. So you could do it before Taylor or Steph or Obi or Ryan could say, I really want to buy some before the breakout. I say, okay, fine. You could buy some before the breakout and then complete your position on the breakout.
Okay.
Right? So I've always found it's easier to manage a position when you have a position rather than not have it, right? How many guys set alerts on their screen? I do too. I'm working on something else, the alert comes up. I can't even pay attention.
Gotta have a little skin in the game.
Yeah, exactly. I think you manage it better. So here's another thing where, let's say a stock breaks out and a guy will call me or send me an email. He'll say to me, do you think this pulls back? I want to buy some. And I give them the most honest answer I have. I don't know. Maybe it pulls back after it goes up another 15% and then only pulls back 5%. And if you waited to pull back to the breakout level and you don't have any, then you're really aggravated. So you could try with a quarter of your position. It pulls back, then you add. But if it goes up another 20%, at least you have some on, and then you buy that first pullback. So you don't know. I don't know. And I've committed more mistakes than anyone in this room. Trust me.
If we were at the end of this chart, would you buy it there?
There's no reason not to buy it. So I'm a big believer in the following. I never sell a stock that hasn't punished me. So could this be the end for Amazon? What the heck do I know? Yeah, it could be. Am I good enough to figure that out? No, I'm not. But it has to prove to me that it is deteriorating. Does it get below its moving averages? Yeah. Do the moving averages start to crest? Does the stock rally back on lower volume? Does it get snuffed out? Or I like to say, does it get the Dikembe Mutombo treatment right at that moving average? Then something might be changing. Something might be changing. But it doesn't change above upward sloping moving averages. It changes when the stock crests and then the moving averages crest, right? Tops are processes, bottoms are events. Does that make sense to anybody? Right? A top takes some time to work through. It's called a distribution phase. And the line is investors with superior information sell to investors with inferior information. That's a distribution phase. An accumulation phase at the bottom is when investors with superior information are buying from investors with inferior information.
John, let me pull this up in Legend.
Yeah,
Okay,
sure. Live charting now.
Okay, thanks.
Yeah.
I'm going to keep it on Amazon, John, because I want to expand upon what you just said. So we'll add a 200-day moving average.
Thank you.
And what do you see when you look at kind of a recent chart? I've got you on a daily chart currently.
Okay, thank you. Okay, if I was going to be really critical, I'd say, Amazon has that exposed high back in the summer, then it had a downside gap, and now could it be making a lower high? Maybe. Is it still above its upward sloping 200-day? That's the most important takeaway here. Could this be a top for Amazon? I guess it could. But am I going to get it right because it's above an upper sloping 200-day moving average by saying this is the top? No, I'm not. The odds are not in my favor. So if I'm long this, I think it deserves the benefit of every one of my doubts. Every one of them.
Let's take a look at another one that I know is popular amongst the crowd here and has been in the news a lot over the last year or several years. Tesla.
Okay, so I'm going to open my kimono and lay myself at the foot of your altar. So I got really lucky in the period where the stock peaked around 450 and got down to the low 100s. I was negative on the stock there. And you could see why, right? It was up above an upward sloping 200-day. It made a lower high. It corrected below the 200-day moving average in early 22. Then it corrected to a lower low relative to that prior low. And then it made a lower high right at the downward sloping 200-day moving average. If you didn't know this was Tesla and it was John's sporting goods store and it hit that 200-day moving average right there where Taylor drew that circle, would you have been a buyer or a seller? Seller, right? And listen, I'll tell you something. That stock doesn't know you own it. It doesn't know you. It doesn't. It doesn't care about you. It doesn't know anything about you. If you sell it, it's not going to avoid your phone calls. Don't worry about it. If that stock right there, if it was any stock in the world, but it happened to be Tesla, you had to be a seller. Now, could I have been a buyer at the 2023 low? No, I couldn't. Could I have been a buyer right there where Taylor just had that, where he just, put that? No, I couldn't. Then it gets back above the upper sloping 200-day. Is there something there? Yeah, maybe. Then it fails again in early 24. I said to myself, I think this is going to retest the lows from 2023. Had a downside gap in addition, and then it doesn't retest the lows. So to be quite honest, I really hate working with this stock. It's hard. It's really hard. It's hard. I know that I don't have any edge. I had a terrific edge where that little ellipse is right there. I had a terrific edge. I had a terrific edge for that kind of situation early this summer for interest rates. I had a terrific edge earlier this summer for the price of oil. It was in a similar kind of situation. Here, okay, it's not my style. I'd rather look at something else. So no edge.
Let's turn it to the audience. I just want to see if there's any name that you guys want. NVIDIA. Okay.
A couple, so.
Yeah. Well, let's take a look at NVIDIA quickly.
Okay, so I'm gonna ask some questions. Let's do this together. Is NVIDIA in an uptrend? Yes. Terrific. Is NVIDIA above its upward sloping 200-day? Yes. Does NVIDIA get the benefit of every doubt? Yes. That was an easy lesson, wasn't it? Everybody gets an A.
Is this a base for me?
So this was a base here from 2007 through 2015. I mean, look at that. Yeah, Taylor, right there. Can you draw that line? Yep. Yeah, terrific. Take it straight across. There was your base, right? Split adjusted, whatever the figure was it a buck and a half, a buck and a quarter, whatever. That was the base. And then you had another one in 2019. You see that little one, Taylor?
Yep.
Right there. Yep, right there. Okay, terrific. And then you had another one here in the end of 23, early 24. So NVIDIA's giving you a chance to buy. It gave you a chance to buy in 2019, 2020. Gave you a chance to buy in 23, 24. There are bases here. NVIDIA hasn't been a moonshot straight up. It's given you opportunities. Is there a potential another base forming? Sure, why not? Good. Come up here.
Oh, no.
I love your enthusiasm.
I do love it.
What's your name?
Fancy.
Hey, John.
Thank you.
So what do you think? What do you think?
Well, so I'll tell you, I've done a lot with NVIDIA. I was watching it before the pre-split, watched it post-split when it did the 1 for 10 back in June, early June. I've seen the trend with it. I've seen how much they've done in revenue last quarter. It's $30 billion in revenue for the quarter. And that's just unbelievable. And then they're doing a $50 billion buyback. So a lot of momentum there, a lot of good catalysts. And then in addition, with NVIDIA is they partner with so many companies. I mean, look at they got more business than the IRS.
Oh, I like that line.
More business.
He's got to be on the second
He's
next year.
on the stage next
Thanks,
year.
Ed. Thank you very much. No problem. So I'm going to give you two little funny observations. In the summertime, just before NVIDIA made that print, I was on a texting session with two of my friends, they're brothers. And one of the brothers, his name is George, his nickname is Pooh, texted me with his brother on it, whose name is Anthony, but his nickname is Iggy. And he said, John, what's the rule on this with respect to a baseball play? And so I replied back to him, and his brother Iggy said, the two of you are killing me. I am trying to trade NVIDIA after hours. And then he said, you know, John, I told my wife I love NVIDIA more than I love her.
Oh, fantastic. Wow. Well, with that, is there anything else anyone wants John to take a look at before we wrap up? Oh gosh, so
I
many.
heard Apple. We have it on the list. I know it's popular amongst the group.
So Taylor, can you draw a little horizontal line right over here?
Can you tell me dates, John, please?
In the early 2020 period? To the left? Yeah, right there. Okay, right there? Good. Terrific. Can you draw a line? Because this one didn't work. Let's do it from the late 2020 period into, let's say late 21. Up more. That peak right there, take it straight across. Okay, good. Okay, it worked for a little bit. And then can you do it from the highest peak right here to the left of me? Take it straight across.
Yep.
Okay. So Apple really kind of was more volatile than I would have thought, given the size of it and given what the institutional sponsorship of this is and given what the retail sponsorship of this is. This was the clearest, easiest base. Got down to its upward sloping 200-day, rallied back dramatically, breaks out, big run. Kind of trades around, jerks around, breaks out, has a run, then really compromises it. And I'm going to tell you, because I want to be honest, I was negative on the stock at that third peak. 1, 2, 3. Yeah, right there. I was negative on it. I thought Apple was going to have risk to 100. So I was right for a few months and then wrong. It happens. Breaks out of a base and it rallies, and now it looks like it's trying to build another base. There's nothing wrong with this one either. So I'll say a lot of guys that I speak with want to be negative on the Magnificent Seven. I wasn't really that smart. I made my own index before CNBC did, and I called it the Big Seven. If I'd called it the Magnificent Seven, then I could have had another trademark. So this is a beautiful chart. There's nothing wrong with this. This is a long. It's a long. For all the reasons that Andy helped me with earlier, right? All the reasons. It's the same here as for NVIDIA. It's the same. Please.
Thank you so much. We're a bit over time, so we're going to end it, but I
Thanks,
hope you
everybody.
enjoyed it as much as I did. He's a legend.